So I've already met a couple of you, and you've heard my spiel, but I'm Brandon Hinkle, one of the co-founders of EOS Financial, and it is EOS, which is named after a Greek island, so a lot of people say it just sounds weird. So nevertheless, my background, basically, thanks. I was a small business loan underwriter out of college for many years, and then I transferred into more leveraged finance, and then I did workout lending for GE for a couple of years. And through my experience, I kind of realized that the process on both sides, for the bank and the borrower, was really inefficient. There was a lot of pain. There's a lot of pain in the process for example, on the lender side, we'll get in an application, several of them a day, and it'll be 6 pounds worth of paperwork that the applicant will put together, and it takes a full day to get through it in isolation. And a lot of times the applications aren't at the sophistication level they should be to merit a $1 million loan or $2 million loan or even a $100,000 loan. And so right off the bat, you have this bias as an underwriter to disqualify the loan because the numbers aren't reconciling, aren't matching. And so, and on the borrower side, obviously, it's a really painful process. Just by show of hands, I guess, how many of you are either thinking about or have already started your own small business? Okay. So that's good. So now I know to cater it to the script accordingly. So as you know then, if you haven't already applied for a loan, it's an excruciating process just to go through one bank. You have to fill out the application, get all your financials together, then there's diligence questions, and then a diligence meeting. And so it's time consuming for both sides, so we kind of thought about, is there a way to basically automate it so it's kind of like LendingTree, but more like Match.com between banks and small businesses. So there's two sides, trying to put them together and find the most appropriate one. But I'll spare you my spiel on EOS, but just so you have a sense of kind of how this got going and what we do and some of the problems that are out there. So as you know, or as you might not know, the lending process, the way it works is first you have to find out what your capital need is. And there's all sorts of different types of capital needs. Primarily the one that you'll probably be faced with is working capital. So if you're buying products, you have to first front the money for the inventory, convert that to a sale, maybe 90 days later you'll get the money from that sale, so there's this working capital cycle that you need to finance somehow, and typically that's done with a line of credit. Then there's also longer term purchases. Let's say you have to buy equipment that's not going to pay itself back, so to speak, for about a year, 2, 3, maybe even 5 years. So you have to first establish what your capital need is, then you have to figure out what bank you're going to go to. A lot of people do that by a process that I don't necessarily think is the best one. They just ask a friend or ask their lawyer or accountant, who do you like? They usually refer their friend, and then that's really as far as people look. And in my opinion, that's the wrong way to do it. There's a lot to be said for relationships and trust, and so relationship lenders and getting relationships through people that they know is obviously a great way, but I do not think that's where people should stop. I think that's where they should start the process, use it as a benchmark. So what we kind of advocate is casting a wide net. If it's with EOS or with some other network or just in person, just talking to as many banks as you possibly can. That's the investment banking strategy, for example, that works really well when you're selling your business. You're not going to just sell your business or your house to just somebody that you've heard of that might be interested. You want to try to put it out there to as many people as you possibly can to get the best possible terms and deal, and the most appropriate deal for you that you can. So you find, you determine capital need, find the borrower, fill out the exhaustive loan application process. Then the bank will go through and kind of do its diligence, put a little feasibility review together for their chief credit officer, who makes a decision, gives you what's called a term sheet or proposal, where they give you kind of the high-level terms of what you should expect to get. And things that are important are obviously loan amount, tenure of the loan, how long they're going to, if it's an annual line of credit that renews every year, and if there's a fee that's associated with renewing it every year, if it's going to be a term loan, what the covenants are going to be are really critical, because your rate means nothing. If you bust a covenant, meaning if there's a requirement that they put in place that you have to make a certain amount of money, or you have to do something and you don't do it, all of a sudden your interest rate could double. So there's a lot of really important little things to look at, and so you want to kind of understand what those key metrics are beyond just the interest rate. And finally, after a match is made, so to speak, or everyone signs up for the deal, the loan funds. So that's the kind of high level process. But there's just a few things I want to talk to you about today. First thing you should do, and tell me if I have a bad habit of talking way too fast, so tell me if I do that. But the first thing I encourage everyone to do is to pull your credit history for yourself, for all the partners, and for the business. And that's critical because that's one of the first things that an underwriter will look at and say, okay, past performance predicts what it's going to look like in the future since we have nothing else to go on. So if you have a problem with your credit report or credit history, you have to address that. I personally recommend if you pull TransUnion or any of those reports, call them. Don't hire those firms that you see on the television to go and fix your, call them, because usually it's just a doctor bill that you didn't even know about, or People's Energy or something like that. You can get that resolved for free basically, and it saves you thousands, tens of thousands of dollars in interest expense over time. Just get it resolved first right out of the gate. Get your credit history checked and in line to the extent you can. Risk reward. This is also kind of talked about ad nauseum, but really important to think about from your perspective and from the bank's perspective. I can tell you as an underwriter, a key metric that a lot of banks use is they make about 1% net profit on the deals they make for small business loans. Now that's after they pay all the salaries, make all the loan reserves, all that sort of stuff. There's other products they sell, like cash management, and those are also profitable, but just purely on the loan itself, they make about 1%. So if you think about it, every one of us that started a business, myself included, says, there's no risk here. Look at you, I want to run this business, I know how to do it. But the reality is, we all know the percentages on the success rate of small businesses, and they know it better than you do. And so they're making 1%. Think about that. If they make a $500,000 loan that goes bad, they have to book $50 million worth of new loans to make up for that. So they're very, very risk averse, and obviously they got burned real bad in this current cycle. So you got to be cognizant there's going to be frustration when you really believe in your business, but you're kind of starting against that when they've had a lot of people that they thought were great businesses that didn't work. So you're going against that. You just got to go into the process understanding that and really having a really good clean financial package. And also something to consider is the personal guarantee. This is a big decision that I, as an underwriter, talked about ad nauseum, on a daily basis, and also I see it with EOS as well. A lot of people will, especially for new startups, you're going to have to personally guarantee it, which basically means if the business goes bad, the bank can go after you personally for your assets. And a lot of people say, well, that sounds kind of scary. And it was also brought up before, if you're putting a personal guarantee on the line, why not just do what's called liquid collateral and put up your personal assets? Because again, risk reward. If you're securing the loan with cash or stocks or something really liquid, there's not nearly as much risk for the banks. You're going to get a much better rate. There's pros and cons to everything, but that's something to consider as a personal guarantee. As a practical matter, again, I was in the workout group. Don't hold, you didn't hear this here, but as a practical matter, I've never seen a bank really go after someone's personal asset. Or I should say, I haven't been a part of a deal where someone has gone after personal assets. Now, part of that is because I left the small business underwriting after about 5 years, got into bigger deals where personal guarantees are less prevalent. But I can tell you, as a practical matter, it's usually more expensive for a bank to go try to liquidate your personal home and your personal assets then they'll spend more on legal fees than they do recovering the proceeds from that. But they can do it, and a lot of times they will. That being said, personal guarantee, the goal of it isn't to liquidate your assets. It's to align your interest with the bank's interest of you paying the loan back. Okay, so it's really important to think about that. When you're personally guaranteeing it, a bank is going to say, okay, if you don't personally guarantee it, it means you don't stand behind your business, so why should I? Critical point. Strongly recommend, if you believe in your business, personally guarantee it. It's going to save you money, and it shows that you stand behind your business. So organized application file. 40% of the deals that I saw, terrible application. Maybe the numbers didn't reconcile. They were missing. It was missing information, and it kind of gives you a bias to the deal. Like, well, if they can't even reconcile their own financials, how can I trust that the numbers are right? Are they really organized? And you got a lot of other applications that everything does reconcile. So it's worth the time to spend. Your accountant, get the numbers right, get the application clean, and make sure you have everything they need in there, because you won't really understand it until you go through it. If it's not a perfectly clean fill-out application, you'll pay the price, literally and figuratively. Relationship versus transaction decision. This is something that is sensitive to a lot of lenders, but it's an important discussion point. So a lot of banks will tell you, and I was part of one of them, they'll say we're a relationship lender. And the first thing I would ask you to ask them is, what does that mean? How do you define relationship? Does relationship mean if I bust a covenant, you're not going to do anything? Or does relationship mean you want all my assets in my entire relationship? And it's you know, sometimes it's both. But there's a lot to be said for you know, a strong relationship does go a long way if they know you well, and if you have a lot of assets. Again, the risk reward. If they are risking losing all your personal assets from making you mad and walking away, then there's less reward for them, so they're going to do what it takes to keep you there. But just remember, you know, there's transaction. There's, you know, a lot of they'll call them, I'm a relationship lender, or they'll say the other ones are like the huge houses are big transaction. They don't care about you as a person. They're just huge volume. They'll give you the best rate, but you know, they're never going to go golfing with you. They're never going to, you know, be there for you if the covenants are busted. So I'm not going to tell you which one's right or wrong. I'm just going to say it's a comfort thing, but make sure you understand what kind of relationship or bank it is. Are they interested in the relationship, or is it a transaction? For both sides. It's important for you to know where they stand and for them to know where you stand, if you're going to be there as well. And then auction process. So I talked about this before. I'm a firm believer that in order to get the best possible deal you can, it's not just rate, but the best possible deal you can, cast a wide net. You know, run your own mini auction process. Again, don't have to use us, or there's other services like us that are more manual. We're automated, but understand the process, go through it, talk to many banks, and really that is the best way that you can find. You can learn a lot through the process and find what the right relationship is for you and what the right bank is for you, and vice versa. So again, it's kind of like, you know, in the dating world, like Match.com or whatever, it's like there's a lot of fish in the sea. There's a lot of banks out there, and a lot of them have different criteria. Some care mostly about cash flow, then collateral, then a personal guarantee. Some of it's the total opposite. Some care about personal guarantor and your personal assets first, then collateral, then cash flow. And depending on what kind of business you are, it's very important to know, because those banks, if it lines up, if you have good personal guarantee but terrible cash flow, maybe you should be talking to a cash flow lender, but you don't know that because you've only talked to one bank. So I've probably gone over my time limit, but again, I just want you to keep all these 6 things. We can talk all day about the process, but these are, from my experience, really important things to think about as you go and try to get the best deal that you possibly can out there. So with that,
great, Brandon, thank you.